We seem to be living in a world of extremities. On one side of the world, there's war. On another side, there's opulence. On some side of the world, there's a slowdown in the economy. And it is indeed a time of uncertainty. And to enable us understand about how this world is shaping up, this afternoon, I have with me two of the best minds on the investment world for HSBC. Good afternoon, ladies and gentlemen. Please join me in welcoming William Sells, the Chief Market Strategist and the Chief Investment Officer for the Global Private Banking and Wealth for HSBC. Will, good afternoon and thank you for joining in.
A real pleasure.
I also have with me James. James is a friend, but more importantly, he's also the Chief Investment Officer for Southeast Asia, covers the Asia markets and Indian markets very closely. Specifically for this afternoon, between William and Sells, William and James, we are going to possibly ask James some very difficult questions on India. So James, welcome to the call.
Well, pleasure to be here.
So thank you. I think, William, I'll start with you. We've been seeing some of your reports for the last couple of weeks, and right before this call, we were talking. The world, of course, is looking very different from what it would have looked a couple of years ago. What is your sense? How do you see this world? How do you see the investment opportunity? How do you see the whole economy piece shaping up?
Yeah, exactly. We've titled this, presentation and this discussion "Opportunities in a Complex World," and I don't think that the word complex will be much of a discussion point. I think everybody will agree with that, as you said earlier on. It's really sort of trying to unlock those opportunities, which is what we're really here for, and so that what we'll be going through. So if we start the sort of the number of slides that I presented, the way that we see the world, clearly there is a risk that if you focus too much on those uncertainties, that you will miss, the things that are happening, and that will support, the investment space. So if we can sort of start to flip through the slides, so the first one is really sort of a representation of some of the things that are going on around us. You saw, you've already talked about tensions in the Middle East, about the US elections that are going to happen. Obviously, what is the impact of AI, the climate change, and then all of the elements that are going to be around us. We've structured this presentation around some of the most important questions that we get from clients. So hopefully, in that way, it will be most useful to you. And the first one that we get is around, well, why should I put my cash to work? In the US, you get 5.5%. In India, you get even more than that. But we've had this question almost consistently. Actually, already last year, we got the same question. And we show on this, on this graph here, what happened last year. Those are all returns in US dollar terms. So if you want those, converted in rupee, add about 0.5% to that, because that was a little bit of rupee weakness last year. So you see, with the exceptions of Chinese stocks and oil, almost everything in positive territory and almost everything, above cash returns. What I present there by the SAA, strategic asset allocation, is just a very standard diversified portfolio with bonds and stocks, nothing racy there. You would have made 14%, last year, so a lot above cash. And in fact, 2023 was a year when the Fed was hiking interest rates and the economy is slowing down. And I think actually this year you are going to have much more positive fundamentals. So we're hopeful that in 2024 you're going to have a positive return, as well. Why are we saying that? Because if you look at the economic forecast, which is on my next graph, you are going to have, of course, a slowdown, and we all know that. And that's not good news, obviously. But there's nevertheless some positive news around this. Number one, all of the numbers that you see here on this chart are positive. So we are not forecasting a recession, and we can elaborate in the Q&A why that is. Also, those numbers tend to be a little bit above the consensus. So HSBC is a bit more positive than the consensus around economic growth. And also that with the resilience of the US, which is obviously the biggest part of the global stock market, that's quite important. In Asia, good growth numbers, China, even though we have a slowdown, it's a mild slowdown. The government tries to manage around the 5% level. And then obviously India, very impressive. Around Asia, the thing we underscore is that there are several engines that keep, Asia going. So better than expected, even though it is slowing down. The other element, which is even more important for markets, is that the Federal Reserve and other central banks are cutting rates. Again, I'll talk most about the developed markets. James will do the emerging markets. So I'm showing here the US Federal Reserve and then Europe and the UK. We're going to see, interest rate cuts, probably only 3 this year. The market price is in a little bit more than that, but nevertheless, we are optimistic. The reason for that is that, we invest already now because we do think that markets tend to rally well before the first interest rate cuts. So even if we think that the Fed is only going to cut in June and not in March, as the market is hoping, the market is right to already rally. And what we've done here is we've looked at all of the cycles since the 80s when the Fed cut rates and represented the moment that the Fed started to cut rates by the 0 point and then worked back. What happened over the number of months before that. And on average, what happens is that markets start to rally 7 or 8 months before the first interest rate cut. And they rally by, a substantial amount here, 8-9%. So that means if we start to cut indeed in June, it's completely normal that markets start to rally in November or December. So don't be worried about that. And also, obviously you don't want to miss out. You want to make sure that you are invested before that first interest rate cut. The other thing which we want to anticipate is, when I talk to clients, they tend to want to buy on a dip. They think there's going to be a little bit of volatility, but they want to step in case there is a little bit of a correction. Well, look at this. So many people in the US have so much cash on the sidelines that all want to do the same thing. They all want to buy that dip. So almost by definition, that dip is not going to be, very deep. Where we put our money to work first is in the bond market. And I'm going to show you, where we do that. So those are bond yields. So the average income you expect to earn between now and the maturity date of the bond. And you see that yield has gone up. So a good entry point from a historical perspective. What I'm showing here is that, and you have different things here that I'm showing. So IG is investment grade, good quality bond. High yield, is lower quality. And then you have emerging market bonds. Now, the difference between a good quality bond and a lower quality bond has not really increased. Therefore, we're basically saying, well, actually, if you can achieve a quite decent yield on a high quality bond, we would stick to that high quality, especially in an environment where economic growth is slowing a little bit. So let's not be too aggressive in the bond market, but let's be invested. So let's lock in those bond yields of high quality bonds because that's where we think the value is. So that's our first question and our first takeaway. On the bond market. If we move to stocks, the general impression that I have is that people are, and we show that in the economic forecast as well, the US being more resilient than other areas in the world. So people like the US from a relative perspective, but they think like markets are relatively expensive. And I want to push back on that. As I'm showing on the next chart, yes, there are a number of stocks that are expensive, but those are the technology stocks. If you look at the rest of the market, it's not that highly valued. So let me break that down for a minute. The S&P 500 is the entire index, but with a big weight for those technology stocks. If you want to take that effect out and you basically say, I'm going to give every stock the same weight and not let Apple and Google and so on swing the entire valuation, then you get a red line. So that's the representation of a fair, of the average valuation of all of the American companies in the S&P with the same weight. So that is not, you see that the valuations are not that extreme. And actually, when you compare it with the bond market, which is my last, the green line, if we can show that, the valuations are not very far apart from what the bond market is telling me. So that gives me another degree of level of confidence that the US equity market is not overvalued. But of course, we need to think there are a number of technology stocks that we like, but we think we need to broaden out and also take exposure to other sectors in industrials, in energy, and so on. The reason why I'm happy to take that exposure in energy is because the earnings, are relatively solid in the US. You have seen US earnings momentum, represented by the blue and the red line here, doing much better than what is happening in the UK and what is happening in Europe. And if you look at 2024 forecasts, which are those arrows, we see further upsides, especially again in the US. So valuations are not exaggerated. Earnings are well supported, but where could we invest? So I'm going to give you three ideas. The first one is around AI. And the reason why we like AI and why we don't think it's a hype, there is real innovation there, is because we generate a huge amount of data. Think back from the Egyptian times to today, 90% of all of the data generated over all of those thousands of years is generated in the last 2 years. So no surprise that we really want some help with actually working with that data and making it most productive. And AI is helping us do that. That obviously creates a lot of need for, chips, for cloud, for memory, for, software, etc., all of that kind of stuff. But I also like another idea, which is around, the whole manufacturing activity in the US. You will remember that the Biden administration was very eager to bring back chips production to the US, but not only that, just manufacturing in general. And so there's been a huge investment, which is represented by this line, in manufacturing in the US, which of course then also supports growth and therefore our economic forecasts. But there are opportunities in industrial. So one of the first opportunities for us to broaden out our, exposure. The second opportunity, to broaden our exposure is in healthcare. Not just because, and obviously the pandemic has been a huge trigger action on this. We've all realized how precious our health is. So households and governments are investing in it. But there's been a huge amount of innovation because of the vaccine development in biopharma. And again, guess what? AI is helping here as well to, speed up the production of pharma and new drugs, but also, for example, in the diagnostics and so on. So for me, the message in the US is not to be too obsessed with the valuations of technology, but to think outside of the box and to say there are other stocks that are really attractive and there are better valuations. Another area we like is, in terms of sustainability, some of the, stocks have had a relatively volatile time in 2023, but that was mainly related to, the interest rate cycle. We continue to see opportunities here, and to a very large extent because of that huge investment that you're going to see. A bit tongue-in-cheek, I'm, saying that if the net zero transition was an economy, it would be the third largest economy in the world, and that is because we need to invest 6.7 trillion every year between now and 2050 to get to net zero. And that's bigger than the German and the Japanese GDP. Clearly, a lot of that is going to go into electric vehicles, as you see in the donut, but also in clean electricity production, and also the grid. So that's the transportation of that electricity. So a lot of opportunity here. Investors play a role in financing all of that 6.7 trillion, but they also feel that they are supported by, all of those governments around the world, and, lots of cities, regulators, and the public opinion. So I wanted to shift to, our final question that I want to debate, and that is, about, the uncertainties. And of course, there are a lot of uncertainties around us, starting with the elections. And I've often asked about the US election in the developed markets. Clearly, that is going to be an, huge element. But I think more in terms of entertaining television for sure. Clearly to some extent, there are a number of elements that we know. I think we know who the two candidates are going to be, because Trump obviously has such a big lead. We know as well that the US-China relationship will remain difficult regardless of the outcome. I think we probably will also have a gridlock situation again, where the president doesn't control the House, the Congress, and therefore that kind of limits a little bit the degree of legislation in there for the potential of volatility. So it will become a topic. I think it will become a topic later in the year. So for now, I would focus on the fundamentals that we have described, that earnings growth, those interest rates and so on, which I think are positive, for the US and for investors in general. In Asia, we're sitting here, we have a lot of elections as well. And obviously, you are very much aware of what is going to happen in April and May. In India, the polls are suggesting a continuity. And actually, in most cases, of all of those elections, we're looking for continuity. In Indonesia, you might have a change in the party, but continuity in terms, of the program. So again, the way that we would manage the volatility or the uncertainty around it is by portfolio diversification. So have stocks and bonds in the portfolio. Focus on companies with solid fundamentals who have that earnings power and that staying power. In the bond market, focus on the high ratings. And I think that's how you manage volatility, rather than being afraid at every single headline and being out of the market, because 2024, should be another good year for investors. Now, I am in Asia, and on the topic of Asia, so I'm going to hand over to our, head of Southeast Asia and India, James Chio, to talk us through his views on the region. James, over to you.
Well, thank you, William, for setting the stage. So clearly, I think the story for 2023 last year was a slower China. It's likely that this situation will continue, but nevertheless, what does it mean for the rest of Asia? But to put into perspective, I think it's very clear that Asia will remain the biggest contributor to global growth. Like it or not, Asia over the next 5 years will contribute at least almost about 40% of growth that's going to come from Asia. And China, though it's slowing down, it's still a big component of growth, given that it's such a large economy. So at least 20% of global growth will still be from China, and increasingly, India will matter much more, almost 7% over the next 5 years. But I think one of the features that we have seen over the last 3 to 4 years has been a sort of a systematic de-risking by global fund managers in China. That has to do with a lot of factors, whether it's the slowing growth of China, or a lot also had to do with policy uncertainty. So this is something that has occurred over the last 3 to 4 years. We are neutral on China right now, but I think our message really is that don't write China off. There could be upside risk. There are sectors, particularly some sectors in service consumption, that we like and think that it has opportunities. But of course, many people are still very, I think, too pessimistic over China. But it's very important to go beyond just sentiment and mood. You want to look at the fundamentals. And the fundamentals for equity investing has a lot to do with earnings growth. And if you look at earnings growth for Asian equities this year, it's actually 20%. And that's extremely solid, extremely healthy. And if you break that down, Korea is actually going to contribute around is going to grow around 64% in terms of earnings growth for Korea. A lot had to do with the recovery of the memory chip cycle that we are seeing starting to happen. But also, if you look at other countries such as Taiwan, likely to grow 18%, India 17%, and even China, earnings growth is still going to be quite healthy at 15%. So I think investors cannot afford to kind of ignore all these positives that are coming in, especially in Asia. And of course, in Asia, there are many themes that we want to think about, but also for investors, you have to think about valuations. So the valuation for Asian equities is around 12 times of its earnings. It's roughly about 25 or percent cheaper compared to its own history in many ways. And I think if you want to compare that against the US stocks, it's roughly about 35% even cheaper than the US stocks. So there is a case when you think about Asia to invest as a whole this time round. But there are specific themes that are emerging. And one of the themes that we like actually is kind of the reshaping of the Asia supply chain. We are seeing this play out. China's exports to the rest of the world is starting to slow down. And at the same time, a lot of this export growth is actually going to India and ASEAN that is actually benefiting from the reorientation of supply chains. Really because a lot of the investments from China is actually flowing to ASEAN and India. I mean, take for example, in India's case, a few years ago, Apple wasn't even produced in India. Right now, around 9% of an iPhone is actually assembled in India. And in the next few years, 25% of iPhones are going to be assembled in India itself. So I think this is a remarkable shift when it comes to the manufacturing capabilities and improvements of ASEAN as well as in India. But also another theme that is playing out this year and the years ahead is consumption. Consumption growth is still going to be extremely strong in Asia. That's backed by favorable demographics, rising middle class, incomes are rising. And if you look at the equity sector, Asia consumer discretionary, they can easily grow about 18 to even 19 or 17% in terms of earnings growth. So the future is really in Asia, and especially with its consumers. So another trade that we like, you heard from William, we like investment grade bonds. But I think many investors ignore Asia investment grade bonds. And I think that's an area that we think is going to look interesting because we're going to have many central banks across Asia, from Singapore, Taiwan, even Indonesia, India. All these central banks are going to cut interest rates. So with the interest rate cut that's going to be happening this year, this is going to benefit many investment grade bonds, especially in Asia. So it's quite important to be positioned for that. You want to kind of lock in that yields and also be paid to wait for the interest rates to fall. And the good news is that in many parts of emerging Asia, the policy in terms of monetary policy has been much more credible, much more solid compared to 10 years ago. And in many ways, a lot of the central banks in Asia can actually cut rates faster and even larger than what the US is doing. So you can get larger capital appreciation being invested in Asian bonds. So we do see certain sectors that we like in Asia, particularly in Asian financials, for example, in some of the Japanese and even Korean financial names. I think these are some of the sectors that we think look quite interesting for us. We also like, in many ways, some of the banks in Japan and Korea, insurance companies, banks in Australia, Singapore, Thailand, and also Korean investment grade corporate bonds, Chinese TMT credits. I think these are the places that we are very interested. We think that there is potential. And of course, Indian credit, Indian local currency bonds. I think that's where our very strong bullish call is on. And I think all of you here will know the prospect of it, really because not just on the economics, but also because of the inclusion into some of the global EM bond index. It's not just JP Morgan announced it last year, and recently, 2 days ago, Bloomberg has announced the plans to include into its emerging market local currency bonds. So all these will provide much more impetus, especially to the Indian bond market. So another theme that we like is, of course, the rise of India and ASEAN. I think this is, to me, ASEAN and India is the new AI, the unassuming AI that's going to be a big factor in the years ahead. It's going to be powered by supply chain diversification. But ultimately, why factories want to shift to ASEAN and India is really because of that large growing population. India and ASEAN combined, they have 2.1 billion people. And this population is actually growing. On average, the median age is around 30 years old. That's 10 years younger than what you see in China. And the population pyramid, if you like, it's very favorable. On average, people have 4 or 5 siblings compared to in China, whereby a couple have to look after 2 sets of aging parents, and they only have 1 child. So I think this is going to drive India, is going to drive ASEAN in the years ahead. And also, I think in India, it's quite interesting in which the manufacturing and industrial upgrade is not just limited to the manufacturing of goods, but also service exports is something that India is very strong in, and I think will continue to grow even much more in it. Of course, with the rise of global capacity or capability centers, I think that's a big change in which in the past, India was a mere sort of outsourcing for IT services. But I think, especially since the pandemic, it has shown that it can provide deeper and much more value-added services, professional services such as accounting, legal services, R&D, and likes of many other things. So the rise of global capability centers means that even in India's case, almost 40% of the world's GCC, if you like, is actually found in India. And service exports actually 5-fold in last year alone. So I think this trend it makes India stand out as a structural growth leader. So that is the structural tailwind of India. So what does this year, 2024, look like for the Indian economy? Well, I think India can easily grow by 6% this year. When we break down the latest manufacturing data, the purchasers managers index, we do see that manufacturing is actually slowing down a bit. The momentum is slowing, but it's still expanding at a healthy pace, because if it's still at the latest readings around 55 for the manufacturing PMIs, it's still above 50. Momentum has slowed slightly. But what's interesting also is that the service PMI has actually picked up recently in the last reading. So I think generally the economy looks very healthy, it's strong. Some slowing of momentum, I think that's expected. But nevertheless, I think the economy could easily grow by 6%, really because the domestic consumption is still extremely strong. The digital economy allows much more efficiency in the consumption. It plugs in the informal economy to the formal economy, allowing a lot of the productivity that can be unlocked and allow matching buyers and sellers, reducing friction in terms of transactions, and increasing consumption spending in the process. But also, I think very importantly, what we see in India is that over the years, India has built up a very strong foreign currency reserves. This will mean that it's going to contribute much more to its currency stability. And it's remarkable. I mean, if you look through the course of the last 1.5 years or so, the Indian rupee has been trading at around 83 to the dollar. Very, very stable. And I think this trend would likely continue. Our view is that Indian rupee would end the year against the dollar around 84. So this whole reforms, economic progress, especially when it comes to improving the macro economic fundamentals, I think that actually contributes a lot to the currency stability that we are witnessing and have witnessed over the last 1 to 2 years. Despite at times even high oil prices that used to hit India, I think that in the past was a factor that could actually bring and weaken the currency. But this time round, we are seeing extremely stable currency. So I think a lot has to do with this build-up in foreign reserves. And of course, in terms of interest rates, right now we think that inflation, yes, the latest reading did show a little bit of pickup due to food prices. But nevertheless, I think for the first half of this year, the RBI would continue to be a little bit cautious. They might just cut rates next, especially in the second half of this year. Might not be a lot, might be two times in terms of 25 basis points interest rate cuts, bringing interest rates from 6.5% to perhaps 6%. So this is really where the interest rate trajectory that we are seeing. In terms of the stock market, we are bullish on the stock market. We think that the earnings momentum is strong. India equity consecutively returned positive returns for the last 8 years. Even during the pandemic, Indian equities still continue to return 15%. So this year, with earnings growth at around 18% for India, it's very hard to bet against India despite higher valuation. But if you look under the hood, a lot of the valuation had to do with the small and mid caps. So I think we want to kind of maintain a preference for the large caps, the quality companies, the big companies, and we think that that's the best way to kind of engage and invest into India. So I think with that, we think that there are some actions one could do essentially to deploy your cash, move it into bonds, extend duration if you like, focus on some of the large cap companies because equity is still quite a very important kind of asset class to build your portfolios in. You want to kind of broaden out your exposure. Do not just look at US stocks, for example. You want to do not just look at US tech, for example. You want to broaden out to other sectors as well. And you don't want to be fully exposed into too much concentration, even into a single market. You want to get a globally diversified portfolio. And of course, there are many themes to explore. Sustainability is actually one of the very interesting themes for you to capture the potential of the transformation towards net zero in the years ahead. So with that, I would stop sharing and I would pause my sharing and I'll hand the time back to Saibo for a time of question and answer.
Super. Thanks, Will. Thanks, James. I think you really set the agenda for us. And before we came on this call, we've gone back to the network, to our customers to pick up some questions as well. And I think I'll come straight to you, Will. You spoke about US, you spoke about AI. Two related questions. One is, while US has been doing well over the last year, do you see US continuing to give alpha to us in the coming few months, especially giving to the run-up to the US elections? And two, you spoke about AI and, of course, the power of AI and the fact that AI is driving growth in many other industries. But do you see US having a more broader secular growth trajectory, or you will say it will still be focused on a few larger or a few specific industries as such?
Yeah, so a lot to unpack there, and so I promised to come back to sort of the resilience of the US economy, and to a large extent it is because, if you look at, for example, the US performance last year from an economic perspective, economists tend to be too negative, and the US has consistently surprised on the upside. And the question is why, and I think to a large extent it is because of that combination of different engines of economic growth, but the main one being the US consumer. And just as much as, we tend to say in the markets, don't bet against the Fed, I would say don't bet against the US consumer. They are, savvy, in terms of consumers, but they have also had, a number of things going for them. And one of the things is obviously that the Biden administration handed out a lot of, money to them during COVID, and actually many of them couldn't consume at that point in time because you were locked up at home. So there is that pile of savings that they are now working through gradually, but some of it is still left. So, that is helping them. And now exactly at the time at where those savings might run out, they're now being helped by that falling inflation with some wage growth. So if you have some wage growth together with falling inflation, your real disposable income net of inflation, actually is positive. So the consumer is going to be an engine. I also mentioned that obviously, that reindustrialization is an engine as well. And you talk about the elections. If we were to have a Trump presidency, he is certainly going to want to create again sort of that Rust Belt, that manufacturing element, going to continue to want to support that as well, just like Biden has done with his Inflation Reduction Act and its Chips and Science Act. So yes, we do think that the US stands out amongst developed market economies as being the most resilient. And from a market perspective, obviously, with the US representing more than 60% of global equity markets, it's also a very deep market, a market where you can find diversification, where you can find opportunities. in large liquid stocks. And that's what I like. When you have an economy that is slowing and interest rates that are high, you don't want to be in the small cap, generally, broad brush, right? I mean, there are obviously companies that are solid, but the large cap, small cap tends to be a bit more cyclical and tends to be more vulnerable to an economic downturn, tends to be more vulnerable as well if there were a bit of a credit tightening of credit conditions, if the banks were to become more restrictive. And the longer you have interest rates at a high level, the more likely that is to happen. So certainly we would, James mentioned it as well, large cap, and high quality. So those are the things that come, to mind. The US, yes, the third motor, the third engine is that AI. I am European, and the European Commission and European countries are scratching their head as to, where can we, get a stake in this technology sector. There are a handful of companies, but, the US has such a competitive advantage on this, that they are going to see good productivity growth. Clearly AI is a way, to do that. We're all starting to use it. I think, most people on the call, when they, in their work, we're starting to, sometimes for the moment it's a little bit of a gimmick, but it helps us at the margin. But I do think that will see exponential growth. A lot of people who are in operations, in the COOs of the world and so on, they are really going to start to look at that as a way, to enhance productivity. I don't think it will crush the labor market, by the way. I think we will just, want everybody to be more productive. And again, the US, probably stands out as the big winner here. So those are a few things that come to mind on your question.
So Will, what you're saying is that there is the reindustrialization, in one sense, is a large theme that's playing out. You're saying consumption, because of cash at the hand of the consumers, is a big play. And thirdly, when you say AI, like we all in some manner kind of appreciate AI is not just by itself, it is also driving productivity across a range of industries. So it's a bit of a comprehensive growth, if I could call it.
Exactly, because in AI, you obviously will have the companies that enable us to do this. And this is going to be the chip makers. This is going to be the software. There is the cloud. There is also, a lot of this will be mobile. So there is, the telecom companies even, I know the mobile phone companies, the mobile phone creators are starting to integrate this as well in terms of their ability. But so those are the enablers. And then there are the users. And I mentioned healthcare, where it is enabling us to be more productive and more innovative in terms of developing those drugs more quickly, or the scanners, in the diagnostics, it is helping those even doctors to become more productive. So this is one example. AI obviously in manufacturing is also helping companies to do those dual twins that we've talked about, to do testing, on and to find patterns. Every single industry has become much more data intensive. We know that in the financial industry as well. Every industry, and if you have data. And as I said, 90% of the data generated over the last 2 years, you want to analyze that, and you can't do it anymore in a manual way. Remember when we started our careers, you would probably use a few data points and draw a straight line through it. Now it's crunching a lot of data to come to hopefully a better and more intelligent conclusion, but also to speed up innovation. So so it's the users of that data as well as the enablers, which you find then in the technology sector.
Super. Thanks, Will. James, pulling you into a debate which has been there for a while, which is India-China debate, and the fact that for a while India seems to be a substitute to China. Do you see this to be changing over in 2024? Is India going to be by itself an opportunity that investors will see, rather than only a substitute to what is happening in China?
Yeah, well, I think it's a great question. I wouldn't say it's a substitute. It's always been, in some ways, by institutional investors. They see both big EM countries as a kind of a pair trade, whereby if one does well, they will shift allocation to the other. But I think over the next 5, 10 years, what we are going to witness is a structural slowdown in China. Yes, I mean, China is still growth fairly fast. This year, we think it's going to grow 4.9%. But if you compare that with 10 years ago, it was kind of half of what China was growing. China was growing at 8, 10%. So this slowing of China is only natural because of that whole demographic shift. It used to have a tailwind of a young population. Now it's having a headwind. So, but for India's case, the situation is reversed. India is now experiencing a demographic tailwind, growth easily. We think this year 6%. But if India continues to work on its reforms, digital economy makes things more efficient, manufacturing even more higher value added goods, India could easily even grow faster than 6%, 6.5%, 7%. And you can see kind of a pickup of India's growth in the years ahead. So I think that's where we are seeing a sort of an inflection point where China is slowing down and India is picking up and accelerating in terms of its growth. So I think potentially in the years ahead, and especially if you look at financial reforms that's happening in India, India's bond market, the sovereign bond market, is opening up to foreign investors with all these inclusion. So you are opening up in terms of the breadth and the depth of market liquidity. It's not just in the bond market, but also in your equity market. So equity trading in India is now comparable to that of even Hong Kong, for example. So I think these are things that are slowly kind of matching up in terms of the economic importance of India, but also on the financial market side of things, it's also becoming much more important in liquidity, in depth, in market cap, and important. So I would say that India looks exciting, it looks interesting, but ultimately, knowing that one also cannot kind of write off China, because China still matters a lot and it's very important. So I think it's very important to, for investors in India to not just be 100% concentrated into India. You also have to look at a globally diversified portfolio to think about how you could kind of preserve your wealth over the long haul.
Sure, James. I think one of the points that you make around about India's advantage is demographics, the shifting, positive demographics towards India, and obviously consumption then playing out a big role in what happens from here off. But we also realize that a large, young, trained demographic would also mean availability of jobs. James, do you see India, both the private and public sector, how are there structural things happening in India which you think would enable job creation? And is what happening, is that enough to get this piece moving? Is there more that needs to be done?
Yeah, well, that's a great question. I think as with demographic dividends, it's not just India, but many parts of Southeast Asia. It's both in some ways a double-edged sword, because once you have more people, it means more people to feed. It also means education, for example. How does the government provide education for the young? And at the end, are these people well educated enough to capture the jobs of the future? So I think in many ways, I'm optimistic. I mean, it's not going to be a straight line. It's not going to be a perfect journey, but I think many reforms are moving in the right direction. One key advantage in India is that you are English speaking. So you're plugged into the world economy right away. So this is a very important factor compared to, let's say, China, for example. China doesn't have that English proficiency. So that's why I would say even the likes of GCC is so powerful for India, because you can right away plug into global companies, because with all these kind of hybrid work arrangements, you can have a global team right away and making use of the talent pool within India. So I would say a lot of the jobs that's going to be created in India largely would be especially the high value added jobs will be driven by largely private sector, like it or not, that's going to be the case. But also, I think you're going to see, very importantly, we all are experiencing the digital economy that accelerated because of the pandemic, whereby domestic consumption is a big part, but a lot of the consumers and also the sellers, the small medium enterprises, are kind of cut out from the formal economy because they lack access to infrastructure. They can't bring their goods to the markets. But because of the digital economy, that informal part of the side of the economy is now plugged into the formal economy. And that's extremely efficient because buyers and sellers can now transact easier. There's less friction in terms of costs and transaction costs. From a small, medium enterprise perspective, they can now access the entire market and a big market that they could have, rather than being restricted very much by a small geography, a little street that they used to operate in. So I think there are a lot of efficiency gains that could happen. And this is a kind of a melting pot, a good place for startups, a good place for tech to kind of add new ideas, come out with ways to make things more efficient, whether it's in fintech, whether it's in e-commerce. And I think this is going to create a lot of exciting activity, create new jobs of the future. And of course, you will see the rise of AI, artificial intelligence being applied to the digital economy in India. And I think that's going to be also extremely exciting. So yes, demographic dividends, double-edged sword, but as of now, from the economics of it, it looks like India is kind of benefiting from it. Great question.
That's good news, James, for India, of course. Thank you for that perspective. Will, we are receiving two interesting questions on the global economy, and I'll take this opportunity to ask you these questions. The first one is, what are your estimates of retail inflation in the developed world for next year? Do you see that to be a concern? Which way is that going?
Okay, so we've written about this a bit as well on LinkedIn in some of our latest posts. Both James and I are quite active on this. So happy for you to follow us on that. Inflation will come down, continue to come down, but obviously, sort of the progress from the 8-9% to the 4-5 is easier than it will be than is the progress from 3 to 2. Sort of that last mile is the most difficult one. Obviously the first drop, was mostly due, to commodity price inflation that came down. Also those blockages that were there, when the economy reopened, remember, and, China was not able to produce everything that we wanted in the West. Those blockages are now solved. Transportation costs as well. From the east to the west, have been easier. But now what needs to come down is, everything that is to do with services price inflation. And the problem is, I mentioned, and I think this is the case here in Asia as well, is that, a lot of the, as the economy reopened, we all wanted, to start to consume services again, which means restaurants, travel, all of those kinds of things. And there is a real bottleneck and a capacity issue in some of those areas. So that is relatively difficult to solve, because a lot of those people that, during COVID, left, obviously, the travel industry because they had no job there anymore and went to work in manufacturing, they are not going back. So there is a real bottleneck that will take some time, but that wage inflation is ultimately now starting to come down, with some of the effect of those higher interest rates really, passing through. I think that explains why, the Fed and others have been puzzled by that longer than normal lag between their actions and the real effect, on inflation, but it is ultimately going to come down. Another part of it, and it's a little bit technical, but it is the rent, rental growth, that is starting to ease as well. As you will understand, when house prices start, to peak and flatline, then obviously rent also cannot continue to run away. It is going to start to come down as well. And in the US, for example, that's worth about 30% of the inflation measurement. So all of that is going to come down, but it will take some time, before we get from 3.5 to the 2%. All three major Western central banks, the US, Europe, Eurozone and the UK all think we will be close to the 2% level, but only by the end of 2025. The good news is that central banks don't think they need to be at 2% before they start to cut rates. If they have enough confidence that we are in that we are really on the path, towards getting there, they will be able to start, cutting interest rates. So I think, middle of the year, June for the US and for the Eurozone, and then potentially August for the Bank of England is the moment that they will feel comfortable that they can start to, cut interest rates.
Thanks, Will, for that perspective. So the other question is again an interesting one, and this links to your earlier conversation around global conflict, Will. And this is with regard to what's happening in Suez Canal now. How do you see the tensions around Suez Canal impacting global trade, and is it a long-term thing? Do we see a resolution coming up? That's one. Second is, does India have any impact of this? How do you see that?
Okay, I'll leave the India bit to James, but let me start on the global perspective. From the start of the conflict, obviously we have, the market has been hoping that the conflict would not escalate to involve, Iran directly, and lead to, an escalation of the war, with more and more parties getting involved. So far it's been a war through actions through what we call Iranian proxies, such as Hezbollah and then the Houthis, rather than Iran directly. I think the market perception is that as long as Iran is not involved directly, that it can be escalation can be avoided. Now there is an increased risk, around that. Obviously, the direct impact in the real world is that, obviously a number of the ships have been diverted, which means higher costs of transportation, but also delay. So if this, lasts for, a longer time, then those delays pile up, and ultimately you get shortages of some materials, that consumers want or that producers want. So if factories can't get their components, then again, you have the familiar thing that we, got used to during COVID in an extreme way. I wouldn't think it is, it will be as big as what we had during COVID, because clearly the production, by China and others of the components is still there. It is just the transportation that can be interrupted. We all have to hope, obviously, that it won't be, a very long, extended period during which there would be that interruption and the reorientation of those supply chains. Again, to come to the central banks, even if you have a spike in prices due to this, and especially from a commodity perspective, I don't necessarily think that central banks would react to this by hiking interest rates. You could potentially have a little bit of a delay in the first time that they will cut these interest rates. We have it's difficult to hedge yourself against this risk. We have a partial hedge to this through our overweight of energy stocks. So maybe that is an idea to look at for those people who are worried that this is going to go on for longer. James, on the India question, do you want to opine?
Yeah. Well, I think the implication on India is, I think, on a few levels. I think, to me, inflation is one thing to kind of watch out for. But again, like what William say, central banks would see this perhaps as something that's temporary, rather than it's permanent. And so from that perspective, the impact would be largely through goods and particularly shipping costs that's going to go higher for imports that India is going to buy. But I'm not too worried, because the larger kind of the CPI basket is largely in India, is largely food, which is largely domestically produced. So that's something that I have to kind of rather watch out for. But also another risk, I think that another risk, of course, would be oil price. If that does affect some of the shipping of oil, or even affect some of the supply of oil, if that escalates oil price to, say, even above 100, 120, I mean, that's a risk. I think something that watching out for, and whether it will translate to have an impact on India. But I think by and large, if you just look at the economy is largely domestically driven by consumption. Exports, imports matter a little bit lesser. And given that this is a sort of it's not going to be something that's going to be permanent in that sense, I don't think one should get overly worried. But of course, let's just be a bit vigilant and just continue to monitor the situation there.
So thanks, James. I'm talking about India, James. Earlier, when you were talking about India, you spoke briefly about valuations. I think, James, like many emerging market economies, there's always a concern on valuations. India is always, in many quarters, thought to be significantly overvalued, and should this really be part of a portfolio, etc. What's your sense? Do you see India to be overvalued? Do you see any specific trend here? How do you see this playing out in over the coming few months?
Yeah, well, I think it's a great question. In terms of valuation, you always have to match that with return on equity. You have to match that with profit growth. And I think why India is persistently higher valued than compared to the other Asian markets is precisely because the Indian companies are much more profitable. That's the simple answer. And it shows over the last 8 years, India has returned consecutively 8 consecutive years of positive returns. And over that time, it has always been higher value than the rest of the world, particularly in Asia when you compare that with some of the Asian markets. So I'm not too concerned at this stage. To me, where I'm concerned about is that if I do see a slowdown in the earnings momentum, for example, if I do see a breakdown in some of the big companies in terms of how they maintain their profitability, then I get a bit more concerned. But as of now, just based on valuation alone, it's not something that worries me. But of course, if you kind of look under the hood, some of the small cap companies, some of the mid cap companies that are trading at 40 times PE, those I'm a bit concerned because their earnings growth are a little bit wobbly, and they don't have that solid kind of business model that they could actually, unlike the big caps that they are in some way a monopoly, or that they could even big kind of business modes that they can capture the big markets with a consistent earnings growth over many years. A lot of these small caps are not that kind of company. So I would be a bit concerned with the small caps, but especially those that trade on high valuation. But for the large caps, if they're trading at on average 20 times PE, but if they give ROEs of 20-25%, and if they have earnings growth of 20% each year, I think these are very solid companies, and the valuation for these large quality companies that have strong business modes and well managed, those I'm not very concerned about. But of course, the small cap ones, I would be a bit cautious over.
Thanks, James. And James, you again spoke about interest in India equities and interest in India fixed income, especially given the developments which have taken in the last few months. For an Indian investor, how do you see this? Do you see diversification to be remaining an important theme, or do you see there to be an equity bias for an investor into India?
Yeah, well, I think for a global investor, they should be invested in India. But for a highly concentrated Indian investor in India, and particularly I know many Indian investors are largely kind of invested into the small cap rally. It's done extremely well. I think this is the time to kind of, the first step is of course to diversify into the large cap. I think that would give a bit more resilience for their portfolio. But also, I think ultimately the goal is to build a kind of a diversified portfolio, not only within the same geography, but also outside of the home bias that you might have. And most countries typically, and most people typically have a huge home bias towards where they're invested in. So I think there's a lot of diversification that Indian investors can do. They can start to kind of increase resilience even within India, but also to look further outside India for opportunities, but also to kind of build, not just looking at equities, but also it's important to kind of build exposure into bonds as well to give that kind of income that I think could be quite important if things get a little bit uncertain.
So James, basically equities remain focused, but fixed income has an opportunity which we should not lose out on, and diversification remains critical, I guess. Will, I think global context. I know we don't possibly cover gold as extensively as we cover the equities in the fixed income space, but obviously there's an interest in gold globally and more so in India. But Will, how do you see gold coming into overall portfolios? Do you see it playing a key part, especially in 2024?
It does have a role. I keep this short because I think we're coming to the end here. So gold has been driven up quite substantially, in part because of central bank buying. As people wanted during this complicated multipolar world, wanted to get a little bit away from the US dollar and wanted to, have diversification in their central bank reserves. But that has driven up gold to such an extent that we now have, less of that demand going forward, and also the consumer finds it actually quite expensive now, to buy lots of jewelry. You have some demand, obviously, during Christmas and during Chinese New Year for gold that has driven it up as well. But all of those factors are starting to fade. The biggest relationship is between gold and the US dollar. So, when the US dollar is going up, gold tends to find that difficult to rally further. And we are actually looking for a stronger US dollar. In part, it won't surprise you, because of that resilience of the US economy relative to other markets. If we're right that the US dollar is going to see a rebound, then that is going to be a headwind for gold. Nevertheless, it is a good diversifier. We need diversification in the portfolio, so some holdings of it, but I wouldn't exaggerate.
Thanks a lot, Will, for that perspective. And thank you. We are indeed coming to the end of this session. Absolutely pleasure to talk to both of you. I think the perspectives that you've shared, thankfully, are recorded, and we are going to share with many more of our customers. And we keep looking forward to talking to you again very soon, and let the world flourish, I guess. That's what I'll say. Thanks, Will. Thanks, James, for your time. Really appreciate it. Thank you, viewers. The recording of this shall be available to you. We shall soon see a link being sent across to you on your email IDs. Appreciate the time. Thank you.